politicians think that there's no price for spending $1 trillion in deficit spending every 100 days. I mean, that's the insanity of what we've come to.
All right, get on with it. Hello, everybody, and welcome to this latest edition of Bugle Notes, where we sound off on the topics and discussions that we feel like you, our clients and listeners, are interested in terms of learning about the financial markets and where things are going. I'm Stephen Weitzel, managing partner here at Reveille Wealth Management, and today I'm very fortunate to be joined by my friend and my mentor, Larry McDonald. Larry is a frequent guest on CNBC. He's on Fox Business with Maria Bartiromo. He's a best-selling New York Times author. Recently, his latest work out, How to Listen When Markets Speak. And I'm very fortunate to have Larry join us on the program today to talk about some of the thoughts that he unpacks in his latest book. I hope you enjoy. All right, well, Larry, thank you so much for joining us on this episode of Bugle Notes. And we're here today. First and foremost, I'm going to be asking you some questions about your latest work, How to Listen When Markets Speak. I just want to give everybody kind of a quick background on who you are, how you and I kind of connected. I know, you grew up in Falmouth, Mass.
Yeah.
And, found your way to Wall Street, and worked at Lehman Brothers, famously one of your books that you published about a decade ago, a little more, Colossal Failure of Common Sense, was the bestseller. And so this latest work is really just, kind of a sequel to that in the aftermath of this financial crisis and everything that spun out of that. And then you and we connected via social media about 10 years ago. And you've been such a great mentor to me through time. So I appreciate you taking the time to come on and have a discussion about your book.
Thank you, Stephen. It's been a great ride together, my friend.
Yeah, it has. There have been some dark and stormy days, right? There's been some bright days. I think we can get into that a little bit, but you cover so much ground in your book, and we talk about how there's really a shift in the way we're headed as an economy, as a global society, kind of unwinding things that have been built up for the last 30 or 40 years in terms of globalization, and how in the 70s and 80s, there was this big movement to offshore. We were looking to lower prices for the consumer. Now we're maybe questioning this globalization. We're looking to onshore things now, and that's having impacts in terms of, prices are not going to be moving down as a result of that, right? And that's going to be contributing to more persistent inflation.
Right. And you got to go back to the 2016 election. Trump was very fortunate because he came in at a period where we've taken 5 million jobs out of the Rust Belt. 5 million. And when I wrote the book over the last 3 years, we sat down with families in the Rust Belt, and you talk to fathers that were going to the library because they didn't have the heart to tell their family they didn't have a job, or they didn't want to be an Uber. They worked their whole life in General Motors or Ford, and next thing you know, they're working in a restaurant. It's just the opioid crisis. This has been a major shift where we've raised the standard of living in the emerging markets. If you live in India, you're making 40 times more than your great-great-grandparents, and you have a much better standard of living as a 30-year-old male or female. But the Rust Belt, that the politics of what we've done through globalization is still playing out, and you just look at the Biden team. They wisely picked up on the Trump torch around protectionism, around reshoring I'm not saying these things are great things. I'm just saying like
Sure.
they know that those votes went to Trump a lot. Trump was able to steal some market share from the Democrats, and now what's as we go into the 2024 election, both parties kind of have the similar playbook. They're both offering kind of protectionism. They're both offering reshoring, bring those jobs back, make America great again, whatever you want to call it. Both parties are trying to say that reshoring is making America great again. It's they won't call it that on the Democrat side, but it's very, very inflationary because all the forces that kept disinflationary forces down from 2000, say from like 1990 to 2020, all those are moving in this direction, and it's going to create a much more sustainable inflation path, which means you need an entirely different portfolio.
Yeah, and so outside of you just have more populist politics here domestically. You probably have a lot of businesses that, for geopolitical reasons, are looking to bring things a little closer to home here in North America, following what we experienced with COVID. Let's talk a little bit about the geopolitical dynamic. And so many of these themes in your book are interwoven together when we talk about things like inflation, Federal Reserve policy, the level of the national debt, and a lot of the countries that used to be the natural buyers of our debt, like China. Now we may have more of an adversarial type of relationship with, and maybe they're not going to be looking to buy our debt in size the way that they used to. And the natural consequence to that, if we don't have as much demand for U.S. treasuries, is likely going to be higher rates, right?
Exactly. I mean, one of the key lines in the book is the fiscal and monetary response to Lehman was $4 trillion. So in the years after Lehman, the total all-in fiscal and monetary, the fiscal and monetary response to COVID plus the regional bank crisis of 2023, everything that went into those COVID and the banking crisis, it's about $16 trillion. And both Democrats and Republicans, I mean, when we did a call with Mick Mulvaney, who's head of the OMB, the client call, I think you were on it. And I asked Mick, I said, aren't the Republicans going to try to force, because we saw this in 2012, President Obama had a really interesting agenda, and the Republicans forced austerity onto him. And in this case, there's just no desire on either side for austerity. And so you're spending all that on the fiscal side, you're doing a lot on the monetary side. And like you said, we don't have as many bond buyers globally, and it's a pretty certain cocktail for a much higher rate regime relative to what we experienced the previous 20 years.
Well, I guess in the aftermath of Lehman, in the aftermath of COVID, we had a decade and a half worth of suppressive interest rates, right, in terms of at the floor, at the zero bound. And when you're at the zero bound and you have very nominal cost of borrowing, then the fact that that our politicians decide to add trillions of dollars to the federal debt, it didn't really matter, right? But now it is starting to matter.
And that's part of the book where the Fed has been the great enabler of disgusting behavior in Washington. And they kept rates so low for so long that politicians think that there's no price for spending $1 trillion in deficit spending every 100 days. I mean, that's the insanity of what we've come to. And over time, the market's starting to wake up to the fact that rates, like normally, just look at the last month. We had the VIX was up because of this crisis and confidence around the yen and the carry trade. It's complicated. Bottom line is the VIX went, which is the volatility index, CBOE on equity market. That went to levels we haven't seen, Lehman COVID type neighborhood, right? And the 30-year treasury couldn't get below 4%. You know what I mean? Like in the history, in the last 20 years, anytime you had any kind of risk off, the long end would have rallied a lot more. And
Sure.
the beast in the market just doesn't trust the long end as much as it used to. And the treasury has issued 2 or 3 standard deviations of T-bills relative to longer dated bonds. So it's a very dangerous cocktail. Let me give you an example of what Yellen, she's a clever fox, but it's a dangerous game, because if she had issued $2 trillion of 30-year bonds and 10-year bonds, those bonds move like this with interest rates, right?
Oh, yeah.
So imagine you need to borrow $2 trillion over a year and a half, right? And you're Janet Yellen. She can choose to go 5, 10, and 20-year bonds, 30-year bonds. The problem is when interest rates go up and down, the longer dated bonds move like this. So that's $2 trillion of assets moving like this, Now,
Oh, yeah.
on the other hand, if you issue $2 trillion in T-bills, which mature in one month, 3 months, 6 months, maybe a year, those bonds don't move at all. And so what she did was she sucked volatility out of the market. She supported the equity market, because if that $2 trillion had been moving like this over the last year and a half, that would have created more volatility in the market. It would have created more uncertainty for when people with passive investors wouldn't have been as comfortable just piling money in the market. And lo and behold, we would probably had a not so friendly backdrop for the election. So this is strategic. This is influencing the election. It's fine. Republicans and Democrats do it. Bush did it. Bush did a lot of things. That team did a lot of things in 2008 to try to keep the party going. And that's why big presidential elections often come with very interesting consequences.
Yeah, and it's kind of interesting. I know we've talked about in the past that in 2008, even though the writing was on the wall that we're going to have a really severe economic downturn, even halfway through the year, I mean, a number of mere months before Lehman collapsed, even though George Bush wasn't running for re-election, that it was a all is well type of a message from the White House, trying not to ruin the stakes for John McCain.
Right.
They knew how bad it was. In the same way, throughout 2023, 2024, the Biden administration has wanted to say, look, nothing, there's really no problems here. They don't want to ruin anything for their own chances, whether presidential or congressional elections, here in 2024. And so they'll downplay data, as much as they can. What was it last week? We got the revision to jobs down 818,000, that had been overestimated.
Yeah.
For the last year. And so, yeah, all of these different, these different administrations do it because they never want to admit that things are bad.
Yes, and they have all kinds of pawns. You heard of this truflation, right? Truflation. Truflation must be an arm of political arm, because the argument of truflation is that inflation is actually 1.5%. But then you look at the University of Michigan consumer confidence, right, which is a time-trusted source of consumer confidence information going back decades, and we're at or below Lehman levels. I mean, think about that. So truflation, and Carl Quintanilla and the CNBC crowd, whatever it is, all the friends of the White House, they're telling you this rosy scenario on jobs, on inflation. And when you look at Dollar Tree stores, you look at Dollar General, you talk to CFOs and CEOs of companies that face middle-class families, there's just horrific destruction that politically is being ignored. And that's why investors watching us right now have to be extremely careful, because this is a cocktail it's a very deceptive cocktail that is being pitched to us, and we have to have with portfolio construction the right way.
Yeah, so let's kind of pivot to that. There's so many things in the book that we could talk about. I want to pick out a couple of nuggets. One of the principal ideas that you get into is this idea that the next 10 years, the market is likely to look materially different than it is today. And, in some ways, that environment for people who have just been passively exposed to the market, it seems almost dystopian to think that things are not just going to be easy and that we may have some real consequences to face as a result of, if interest rates go from 0 to 5% on the front end in a very short period of time, what that does to bond prices, and how there have been major losses in fixed income, major losses in commercial real estate. And at the same time, you've got bubbles of fairly epic proportion in areas like AI and technology. And most people who are passively investing here in the United States, they're unaware of the risks that they're exposed to in their portfolio, because in their mind, they have a diversified exposure to the market, when in reality, they're clinging to just a handful of names.
Right. And it's so deceptive because, over the years, like think of the top three names in the S&P, the top three. They were always 8 to 9%, 7 to 9% of the S&P 500. Like you go to the 90s, you go to the late 80s, you go to 2000s, 2010s. The top three stocks are always 8 to 9% at the max. Now we're 22, 23% at one point this year of three names. And so it's extremely dangerous. And look at the NASDAQ 100. There was 24 trillion in the NASDAQ 100 as of like a month and maybe a month and a half ago. 24 trillion. That was up from 12 trillion in early 23. So 12 trillion to 24 trillion. And so America's wealth is essentially massively long what we call financial assets, and it's growth stocks, passive investing, and bonds. Whereas, the rest of the world is positioning, China, Russia, and many other parts of the world have a lot of their wealth in natural resources and hard assets. So right now, the average portfolio in America doesn't own hardly any real natural resources or hard assets. And our argument in the book is that we're going back to a 1981 to say 1968 to 81 portfolio, which had a much higher component of industrials, energy, oil and gas, metals, materials. At one point in 1981, those groups were 49% of the S&P 500's composition. Industrials, oil and gas, metals and mining, right? Were 49% of the S&P 500 composition. As of maybe 6 months ago, that number got down to about 12%.
Yeah.
So the point of the book is we're not going back to 49, but as sure as God made little green apples, I think we're going to 25, which is a major shift for portfolio construction.
Well, and I guess it's really a behavioral thing that it's, I started penning a white paper a number of years ago that I've sworn to people I'm going to finish, called Pavlov's New Dog. And it's this idea that investors are these conditioned beings, and they go to where, their capital has been treated well, almost with asking no questions, right? And so those persistent trends for many years was interest rates were falling since the early 80s, and that bond prices basically went up all the time for 40 years in a row, and they were negatively correlated to equities. And so if any exposure you had to fixed income was going to counterbalance your equity portfolio. So you own bonds without question as your safe money. And then for 15 years, you've had large cap growth stocks in the US that have gone to these nosebleed valuations and have been at nosebleed valuations for a long time. And it's hard for people to even imagine that things could be different in the future. But in 1981, if they had that mindset of I'm just going with what's hot and what's working, they'd have had half their money in oil and gas and materials and the stuff that that was overvalued then.
Right.
Right. And so it's preparing yourself for a market in the future. Now, at Reveille, we don't try to focus so much on the forecasting. It's more on just aligning with the trends in the market, but it's also trying to have a context of understanding that that at some point valuations matter to forward performance, and
especially with
that
higher rates. Yeah.
yeah, especially with higher rates, right? And that there's likely to be a material rotation out of the things that have become the piggy bank for the world's capital, which is largely large cap U.S. equities, maybe treasury bonds, or U.S. bonds have been a real source of capital, or drawing in capital over the last 10, 15, 20 years. And that ultimately that money is going to be looking for another home at some point in time.
Yes. And so the quarter end, which is always like, well, the big quarter in the mid-year and June 30th, was really significant because our data showed, like, if you look at the NASDAQ 100 versus, say, the Dow Industrials, that was almost a category 5 type hurricane, what we call puke, out of the industrials, out of value. And it was really a real high watermark for that growth trade and the big, what we call the Mag 7 and AI. And
Yep.
what we saw in early July, even before the August volatility, there was a real tectonic plate shifting where hundreds and hundreds of billions of dollars in a couple of weeks moved from growth to value, and to some extent hard assets. And so now, over the last couple of weeks, that's really followed through. So all the handwriting's on the wall. In 2022, we had this huge shift. Value destroyed growth in 2022. Also, risk parity, which is the old stock bond portfolio, 60-40. If you look at the RPAR ETF, that's a good measurement for that. Risk parity got destroyed, and that's the thesis of our book, is it's no longer a 60-40 portfolio construction. In 2022, we saw the first tremor before the quake. In other words,
Yep.
that risk parity was destroyed in 2022, and to some extent even in 23. And so it had two really bad years of, and remember, like you said, this was the hallmark, right? This was for 20, 30 years. All you had to do was be long stocks, 60% stocks, 40% bonds. And if you're in your 60s or 70s, maybe it's the other way around. Maybe it should be 60% bonds and 40% stock. The bottom line is it was one big stock and bond pie with no allocation to anything else. We make the point in the book that, like, say 5 to 10 years from now, it's going to be more like a 30-30-40 portfolio. 30% commodities, 30% bonds, and 40% stocks.
Yeah, and so we've written a handful of white papers here over the summer where we've kind of examined this idea that the industry for decades, right? They have loved the concept of something that is simple to market, 60-40 passive, put it in there, don't worry, don't try to time the market, which we believe that nobody's going to time the market to the day, to the week. But that when the industry typically tells people you can't time the market, it's really just them saying, don't ask me to do anything, right? And they just want to find something that's very scalable for them to implement. And the environment was conducive for a number of years that any allocation to bonds, it helped to de-risk. But to your point, 2022 was kind of a shot across the bow to suggest that maybe we don't live in that world, Dorothy, anymore, right? Maybe we're not in Kansas anymore. And simply having a diversified or asset allocated portfolio, it's not sufficient to protect your capital when we've realized that both of these stock markets and bond markets can decline materially. right?
Yes. And what they won't tell you on CNBC, or they won't tell you from the Vanguards and the BlackRocks, they won't tell you is that there's been, in the last 50 years, there's been two 10-year periods where stocks did nothing for 10 years, right? So in other words, the market literally was unchanged for long periods of time with a big drawdown in the middle. And so over time, when they show you the returns on TV or in advertisements, it looks fine because what they do is they wash that stuff out. But when you look carefully, there's long periods of time where that type of 60-40 portfolio, if you're a younger person and you're in something like this and you're down, same thing with like Bitcoin, say you're down 40-50%, and for 2, 3, 4 years, most people aren't going to stick with that, right? But they make it sound like in the advertisement that all you have to do is buy and hold the S&P, and it's riskless. It doesn't work like that. If you're trying to put, if your son or daughter's going to get married, or if something happens, you got to put the kids in school, and you're in this stock and bond portfolio, it worked and worked and worked and worked, and all of a sudden in 5 years you're down 5 or 10, 20%. 5 years you're in the 7 years, and this happened twice in the last 50 years, twice, 2 10-year periods of big drawdown and basically a flat market. And there's a whole cottage industry of salespeople that will not tell you the truth about how things really work.
Sure. And there's a chart. I'm gonna share it here for the folks that are gonna listen, but it's from one of my friends, Willie Delwich, that he actually has a plot where he shows over the last 70 years, and he's comparing household allocation to equities or fixed income, and how, when households are highly exposed to equities, that the 10-year forward annualized return for the S&P compares. And when investors are all in, when households are all in on equity exposure, forward returns are zero. Oftentimes they're negative. People cannot remember that. We're at the same levels today that we were in late 99, early 2000. So the last time you talked about, when the S&P peaked in March of 2000, it didn't make any additional progress in price until almost 13 years later, in February, March of 2013.
And to your point, you got to pound this home. Right now, in terms of American wealth in equities, we're up at that high watermark. Same thing in like the late 50s, we were there too. You remember from 60s and 70s, when there was some real dead time there for the market. So there's been twice now where the household wealth had this percentage of wealth that's in equities, and like you said, that's where the forward returns get pretty ugly. And what's interesting is I pitched, so we came up with the Lehman book. The Lehman book was a New York Times bestseller. Like you said, the book is a colossal failure of common sense. So I'm coming off this New York Times bestseller in like 2013, 14, 15. I wanted to write another book, and we started to pitch Random House. Remember, this book was published in 12 languages. It's one of the best, according to the CFA Institute, it's in the top 20 all-time best books in finance. We could not get a book deal done. And I'll never forget meeting with one of the big publishers, and he's just like, Larry, it's not you. We have a model that looks for financial books, and what we look at is household exposure to equities. And financial books just don't do as well in periods where household exposure is this low. So that household exposure was not high enough for them to publish the book. And lo and behold, in the last year and a half, 2
returns
years,
were great from then, right? If you would have been a buyer,
they were phenomenal. And then finally, they agreed to publish my book in recent years when household equity exposure got high enough. So there's a lot of big models that look at this data, and that's how dangerous we are. The dangerous place that we are at right now.
I've got a couple other things that I want us to touch on today. And some of it's going into we've been talking about the dangers of passive investing. It's become very vogue. It's very scalable for the industry. I wrote in one of my recent white papers about this idea of the perils of indexing, and that is that you end up with more exposure to the things that are most overvalued, and the things that are at the lowest valuations you have virtually no exposure to. And so whether that was tech during the dot-com bubble, right in the 80s, it was Japan, right? I know you spend a lot of time in the book talking about the bubble in Japan.
But keep in mind, this is important. David Einhorn, billionaire investor, Greenlight Capital, I think one of the best investors of all time. He's a guest in our book. We've got some great guests in our new book, When Markets Speak. We've got David Tepper, David Einhorn, Charlie Munger. But Einhorn makes the point that you're making, but he also makes it to the economy. So think about platinum, palladium, uranium, key resources, rare earths that are needed for the green meadow, for electric vehicles, for nuclear power plants. The United States of America is horrifically, disgustingly underinvested. So what you're talking about is that the way money's allocated in equities, it also comes down to capital investments. And so what happens is when the passive investing rolls on and on and on for longer and longer and longer periods of time, the capital is drawn away from the necessary investments in oil and gas, in uranium, in the type of mining companies and all of the companies, cement, all the types of things that you need to really build society and really get to that green meadow, whatever you like, build that, the infrastructure for artificial intelligence, to power artificial intelligence. All of this is just horrifically, disgustingly underinvested. And it all has to do with the mindset of like passive investing, and people just aren't interested in, you try to pitch a nuclear power, think about how many nuclear power plants have been built in the United States in the last 30 years. Think about how many we don't have in the whole planet Earth, right? There's literally the amount of copper plants that are coming online is the lowest in decades, because we've just spent so many years of underinvesting, and it's all these chickens are going to come home to roost in the next 3 to 5 years.
Yeah, so I think this is where, and I'd say that this is where the ironclad laws of economics will prevail, that talk about the cure for higher prices is higher prices, and the cure for lower prices is lower prices. That, as we'd relate it to that, let's rewind 10 years ago, back when energy prices were high, and borrowing costs were low. The Fed was accommodative, interest rates were zero. The energy prices were high enough that people were looking to invest in that area because they thought they could get a nice return on that. And there was an incredible amount of overinvestment in that, created a lot of supply, brought prices down to zero, right? Or negative. The May contract for crude in 2020 went negative. And that was a time where now you had a bunch of investment that had gone bad, that had soured. There were bankruptcies. Nobody wanted to invest in that space. And now the lack of investment in that area when prices were low means that we don't have the supply that we used to, that people invested in when it was high. And so the lack of investment, the lack of supply is going to mean that prices have to go up. And so that's just an example of money gets invested in areas when it's fashionable, when it's comfortable. When it's not comfortable, when everybody's trying to get out, that's when money would best be served going in. And so today, I would ask you and I think you kind of hit on it, the malinvestment today is where?
Yeah, I think aluminum, copper, rare earths, oil and gas for sure. Still oil and gas. We've come up a little we've come up in U.S. production, but we're just back to where we were. Think about U.S. production. We're back to where we were in 2018, a little bit higher. That's a long time. the U.S. population is a lot higher from 2018 to 2024, and so yeah, so we're underinvested in pretty much all the key areas except for artificial intelligence, which they're building. It's the same thing with all these electric vehicles, all this extra power that's going to be needed for crypto processing, for artificial intelligence data centers. And so in some ways we're suppressing supply and we're massively juicing demand. And so that disconnect is going to really rear its ugly head in 2025, 26, which is going to present incredible opportunities for investors, investors watching us right now.
So one of the last questions I want to ask, Larry, and then I'll allow you to get back. I appreciate your time today. But I want to talk about this idea of if there's an end to American exceptionalism, and we can just focus the discussion today as it relates to the financial markets. But we're at a point now where we've got $35+ trillion in debt here in this country, hundreds of trillions of dollars of unfunded liabilities, that when the next crisis happens, the government, they're likely not going to be in a position to be able to add support and accommodation in the way that they used to. So what does it look like in that scenario when that happens? And then what's the ultimate victim in all of this?
Well, it's hubris. Think about hubris. It's one of my Dick Fold, the CEO of Lehman Brothers, the management team in Lehman, that was filled with hubris, and that's blind confidence. And so the politicians in Washington around spending, they think there's no consequence to spending $1 trillion or deficit spending every 100 days. And when it comes to the planet Earth, the sanctions weapon, right? We talk about this in the book, The Multipolar World. We've taken this sanctions hammer and put it over the head of just about every emerging market country in the world. And so and sometimes, you need the sanctions, obviously in the case of Russia, right? But when you overuse the sanctions weapon, it's a type of weapon you should pull out once every decade. Instead, Republicans and Democrats have overused it because king dollar, it's hubris. It's disgusting hubris where they think that there's, the dollar's so strong that the rest of the world's always going to need dollars. And that type of hubris has been getting worse and worse and more abusive. And to the point where we're in a multipolar world now, where we don't have as many friends in the world. You can't even get a ship through the Suez Canal because without a drone striking it, right? That's raising the cost of shipping costs. And so you're creating so many inflationary forces around this multipolar world around sanctions and the fact that people don't trust the US dollar as much as anymore. They want to build like an alternative currency. And all of this, that's kind of the cocktail that's upon us, where it's a multipolar world where we have more global conflicts. Right now we've got two, like a 1968 to 81 world where you had the Vietnam War, you had all kinds of stresses in the global supply chain, and that is very inflationary. And because of hubris in Washington, both on spending and on abuse of the sanctions weapon, that's where we've laid the foundation of a much higher inflation regime.
And I guess ultimately, to your point there, when you're talking about how you now have these other countries out there, they're looking to diversify away from the US dollar. That's the card that the Congress people, the leaders in Washington always had, that they thought would never go bad on them. And if that changes and it's no longer the envy of the world, then things are going to look different for investors globally. It's going to look different for the American people. And, it's kind of a dystopian thought a little bit, but one of the things that you say in the opening part of your book is that, we're not talking about these things to try to scare people. We're trying to come face to face with reality and try to prepare for the fact that things are not always going to be the way that they have been. Larry, thank you so much for joining us here today. It's been great catching up with you.
Stephen, we appreciate you, my friend. Thanks for everything, and I'll see you at the top.
Thanks everybody for tuning in, and we hope that you found this conversation insightful and interesting. Larry's a terrific guest, and we appreciate the time that he sets aside for us here at Reveille Wealth Management. Now, we want to give away some copies of Larry's book, How to Listen When Markets Speak. And if you're interested in receiving a free copy, please send us an email to info@reveillewealth.com. And in the body of your email, let us know that you would like a free copy of Larry's book. We have a limited supply. And so once they're out, they're out. You'll be able to find them on Amazon or in a bookstore near you. But we do have a limited supply that we would like to get out to you, our listeners. So again, thank you so much for tuning in, and we will look forward to seeing you here next time on Bugle Notes.